Hello and welcome. We are here at the SBI's Q3 earnings event and in a special conversation with Mr. Dinesh Khara, Chairman of SBI. Thank you so much, sir, for taking out time for us. So my first question to you is about the capex push that Finance Minister Nirmala Sitharaman has spoken about in the interim budget, which means that the private capex will also follow. So what is your visibility on that? And as things stand of now, companies are actually raising funds on their own through bonds and pushing that. So how soon are you expecting that to come to banks, and what is the visibility on that?
Yeah, thank you very much for this opportunity. And the way I look at the situation is that we are having a very clear visibility in terms of the pipeline which we have. And that is nothing but a reflection of the confidence of the private sector players, and which is of course fueled by the initiatives taken by Government of India in terms of supporting the infrastructure. We have seen it in the past, and now we have got a situation where our pipeline stands at about 4.6 trillion Indian rupees. And I would say that much of it, almost about 75% of this pipeline, is coming from the private sector, and the remaining 25% is coming from the public sector. But yes, of course, it's a huge multiplier. It has got a huge multiplier effect, and that is something which I've already started seeing when we see our SME growth at about 19%. I would say that is a reflection of the kind of multiplier effect which is seen of such kind of investment.
Right, so you have also spoken about the credit demand that is going to come in the renewables sector.
Yes.
And I think SBI itself has a renewable financing portfolio of about 50,000 crores.
Almost about 50,000 crore.
Right. But so there has been a conversation around this that the low tariff cost is going to make these solar power projects non-viable. So how does it impact funding for the solar power projects coming ahead?
Normally, we are all aware that such kind of renewable power or solar power projects have got a plant load factor of about 25% only. So when we are appraising these projects, we are very mindful about this. And also, the kind of rates which are given, they are given by SECI. And those rates are invariably, there are contracts which are entered into. So which means that on the price risk, there is very clear certainty, there is no risk which such loans are exposed to. When we do the appraisal, we are very mindful in terms of how the cash flows will really evolve. So that is not something which is a matter of concern. I would also say that when it comes to solarization initiative which has been announced by Honorable Prime Minister, I would say that it is also given opportunity for scaling up the production in this particular sector, be it solar cell, be it solar modules, be it solar panels. So all this will be a big boost. And also there would be people who will be implementing the solarization plan, so which will actually give a boost to the SME space also. So I think it is going to have a huge impact in terms of the growth for the economy overall.
Coming on to the capital adequacy, you had mentioned when the RBI had announced the increase in credit risk weight that the SBI will have a 50 to 60 basis point hit in capital adequacy. However, today in the earnings conference, we saw that higher credit risk weight have hit CRAR by 70 basis points and CET1 by 49 basis points. So is there any plan to moderate the exposure so that the capital adequacy is not hit further?
The way we look at it is, if at all we can pass on this higher cost of capital to the borrowers who are availing such loans, that will be our effort. So, and we have already initiated steps in that direction. And the way I look at it is that if at all there are opportunities which are decent, which meets our risk appetite, we are there to support such initiatives.
You have already mentioned that your unsecured loan book is safer than the secured loan book.
Absolutely.
Right. On the concerns of strong dependence of NBFCs towards banks for loans, a concern that the RBI also highlighted, what happens to NBFCs as an industry? What happens to NBFCs who are now will not be able to take loans from banks? And what happens to SBI's existing borrowers? Because if they go out to raise funds in the market, they're going to bear a higher cost of funds on that front.
See, we have been supporting these NBFCs all this while, and also all those NBFCs who are meeting our risk criteria. we continue to support them. But how much, it will depend upon how much, according to our assessment, we should be in a position to, we should be lending to them. So I think it's not that the bank credit is dried up for them. Bank credit is certainly available. But yes, of course, some of these NBFCs will be approaching market for raising bonds, etc. So various kind of opportunities will be tapped. And at the same time, these NBFCs also will also ensure that their loan book growth should be healthy. I think that is what the intent of RBI is when they have increased the risk weights and have, which in turn has increased the cost of funds for these NBFCs.
Okay, so the last couple of questions. So PSU banks have a higher portion of MCLR loans in comparison to private banks. So there's a conversation that the cost of the cost differential does not hit PSU banks as much as private banks. So now this is not a permanent solution to the liquidity problem. So what is your visibility on the liquidity situation, and how long can you say that PSU banks will be able to play the deposit rates game?
See, we have got a liquidity coverage ratio which is as high as about 130% plus. So we don't have any challenge as far as liquidity is concerned. And apart from that, our credit deposit ratio was also 66% as on 31st of December. So I think we are having enough liquidity with us, and we can ensure that we should meet the credit requirement of the economy as much as there is a need for it. So there is no such liquidity challenge with us.
But what about the system liquidity at large, sir?
System liquidity at large, normally we have seen that RBI ensures that there is adequate liquidity, and they are coming out with the VRR as and when they are observing that there is a liquidity deficit in the system. They are coming out with the VRR. I would say that it is a very prudent measure to ensure that the inflation should remain in check.
So just last question. So I understand SBI has a decent corporate pipeline, but there's also a clear potential for other banks also to tap into this market, this segment. And now the conversation is that because of the aggressive pricing on corporate loans that PSU banks do, the risk cover is not enough for private banks. As in, this pricing does not adequately cover the risk that the corporate segment has. So, how do you assess that, and do you think there's a risk building up because of the aggressive pricing by PSU banks in the system?
I will speak about State Bank of India, and I would only say that we are very mindful about the risk premium which we should have for any risk which we are undertaking. And we are not compromising on the risk premium which we are required to maintain for underwriting any particular risk. So I think it's not a situation where we are trying to outprice anybody. But yes, of course, very important is the cost of resources. At what cost people are raising the funds, they will have to load the risk premium. So we are in a competitive position, because considering the fact that we have got a cost of resources which give us an advantage, we are not compromising on the risk premium at all.